So that being said, let's focus on what we have for tonight. Tonight, we are going to be looking at borrowing cost, IAS 23 on borrowing cost. Now, the first thing we need to understand as far as this standard is concerned on IAS 23 is that it's not new for organization to incur interest or to pay interest on the loans that they collect from banks or from a financier, whoever give them the loan. When you borrow money, you pay interest. However, when it now involves that the money you borrowed, you used it to finance the purchase or construction of an asset, then that is what IAS 23 is concerned about. When you borrowed money to finance the purchase or construction of an asset. And the key of IAS 23 is that the interest that you pay on these borrowings, the interest that you incur on this money you have borrowed from this financier, how is it treated? How do we treat it? And that is what we want to look at. So we would focus on three core areas, which is the principle and scope of IAS 23. How do you recognize and measure borrowing cost and disclosure requirement? Okay, so the core principle of this standard of IAS 23 is that the interest costs or the interest that are directly attributable to acquisition or construction or production of a qualifying asset will form part of the cost of that asset. Any other interests shall be expensed. So what we want to learn entirely is that when you incur interest costs, when you pay interest to the bank on the money you borrowed, and this interest is directly linked to the acquisition, to the construction or production of a qualifying asset. You see that interest is going to form part of the cost of that asset. Any other interest can be expensed, So you see, what we are looking at in this standard, we are not looking at a cost of equity or the return or the dividend that is paid to shareholders or those that contributed capital. Is the focus of this standard is when you borrow money, is loan, not when somebody gives you money as capital or as equity. The focus is when you borrow money and you are now paying interest on those money, then that interest, if it's related to you constructing or producing a qualifying asset, that interest must be added to the cost of that asset. That interest has to be added to the cost of that asset. Now, first of all, you would see that there are two things that are coming up here that I think I quickly need to address. Number one is interest costs or borrowing costs. Number two is qualifying asset. So we need to address that because I keep saying interest. So interest that I'm talking about is the one you incur in connection with borrowing of money. So if you borrow money from anywhere, they will charge interest. That's the cost of money. You're paying for the risk that the guy had to give you his money that you will pay later, because there is risk that you might not pay back. Or you are paying for time value of money. I mean, somebody that gave you 10 million now, 10 million now is worth much more than 10 million tomorrow. 10 million today, collecting 10 million today is better than waiting for 2 weeks to collect that 10 million. It's better you collect it today. You can collect it today, invest it, earn some money on it. In the next 2 weeks, you're better off. So interest is what you pay to compensate that person for time value of money. It's like the opportunity cost of funds, something like that. That's how economists to put it. Okay, now another one is qualifying assets. You know, assets takes a substantial period of time to get ready for its intended use or sale is a qualifying asset. So we are saying that the assets we are saying you are producing or constructing in a core principle. When I was talking about the core principle, we said when you pay interest that are attributable to acquiring, to constructing, to producing a qualifying asset, that interest you pay would form part of the cost of that asset. You see, this qualifying asset is an asset that takes a substantial period of time to get ready. It takes a lot of time to get ready. And we gave some examples of qualifying assets here. I mean, depending on the circumstance, inventories is a qualifying asset. Now, you see, inventory will be a qualifying asset if it takes a substantial period of time for you to manufacture that inventory. Then that inventory is a qualifying asset, which means that if you then borrow money and you're paying interest while you're producing that asset, right? You're paying interest while you're producing that inventory, then that interest should be added to the cost of that inventory. But if it's an inventory that does not take time for you to manufacture, then that inventory will not be a qualifying asset, which means that if you borrow money to produce such an inventory, the interest you pay to the bank should be expensed. That is, you should take it to P&L directly. So you get the logic now. So a qualifying asset has to be an asset that takes a long time to get ready for its intended use or sale in the case of inventory. Another one is manufacturing plants. A plant that you manufacture yourself, that you constructed yourself, not the one you went to buy off the shelf. You constructed it, or power generating facility that you constructed yourself, or intangible assets that you constructed yourself, or investment property that you constructed yourself. However, you see, for investment property, remember this, if that investment property is measured at fair value, if that investment property is measured at fair value, it will not be a qualifying asset, because we believe that that kind of investment property, you will not have constructed it yourself. It's something you'll have bought off the shelf. That's the position of the standard. So those are qualifying assets, and that is what we are looking at. So before you can apply IAS 23, because the core principle in IAS 23 is that when you incur interest, and that interest you are incurring it because you borrowed money to construct, to produce a qualifying asset, that interest should be added to the cost of that qualifying asset. So we need to readily identify what a qualifying asset is, which I've already identified as an asset that takes a substantial period for it to get ready for its intended use or sale. That's a qualifying asset. Now, interest. It's clear that interests are the amount you pay to the bank. And it's usually based on a discount rate or an interest rate. And the standard gave some examples of interest cost or borrowing cost. He said interest on bank overdrafts and short-term and long-term borrowings. Okay. Amortization of discount or premium related to borrowings. Okay, a lot of you might not really, understand very well what amortization of discount or premium would mean here. You will learn this around when I'm teaching you maybe IFRS 9, then you would understand that there are instances where there would be some imputed costs, or where we want to use market rates to determine our interest rates, whereby we would then have to spread some cost over the life of that debt instrument. Okay, we call that amortization of discounts or premium. Furthermore, there are instances where you would borrow money. You can borrow 10,000 and you are going to be paying back with 15,000. You borrow 10,000, but you're paying 15,000. So there's a 5,000 premium. You see, that 5,000 premium, we treat it as an interest. So usually you will not recognize it immediately. You would usually recognize that 5,000 premium over the life of that borrowings. So recognizing it over the life of that borrowings, that's what we call amortization of discount or premium. There's also amortization of ancillary costs in connection with arrangement of borrowing. So usually when you borrow money, the banks will charge you management fees and some other auxiliary costs. So the standard requires that you spread this cost over the life of, so you treat those costs as interest, as part of finance costs, right? So we treat that as also part of finance cost as well. Also is finance cost or finance charges in respect of finance lease. Very soon I'll be teaching you guys IFRS 16, and you would find out that there is usually this finance costs that usually come up when you borrow an asset and you are paying back for that asset instrumentally, which we call leases. So one way or the other, because it's similar to borrowing money, right? It's because now you're borrowing asset, but you're paying instrumentally, right? So also pay certain level of interest, because you need to also compensate the person that gave you his assets that you should then pay over many years. You need to compensate him. So that's finance cost. It's also an interest as well. Also, when it comes to the foreign exchange market, where there is either you made an exchange gain or an exchange loss, right? So if that exchange gain or loss is related to borrowing, foreign currency borrowing, so that exchange gain or that exchange loss is also treated as finance costs, as part of borrowing cost as well. And this is very common today in the Nigerian economic environment, where entities enter into foreign currency borrowing. When you borrow in foreign currency and the currency move in your favor or against you, it usually balloon your foreign currency borrowing, because the amount you're going to pay in naira might be bigger. So that exchange gain or that exchange loss are usually treated as finance cost as well. So these are what interest can be. This is just here to open your mind that when you're looking at borrowing cost is beyond the interests, just the interest that you pay on overdraft or a short-term or a long-term loan is beyond that. The amortization of discounts, where you're paying much more than the principal you borrowed, or ancillary costs that you need to spread over the life of the borrowings, or the interest that arise as a result of leases or exchange difference arising from foreign currency borrowings. All these are borrowing costs that that can be factored in line with IAS 23. So that's by way of introduction. Now, the second thing that we would really need to look at is that we have established the fact that when you incur interest costs, and that interest is directly attributable to acquisition, to construction, or to production of a qualifying asset. We have established in the core principle that that borrowing cost should be capitalized. It should be added to the cost of that asset. Now we have established that. So it's capitalized. And those are the borrowing costs that are eligible for capitalization, the ones that are directly attributable to the acquisition, construction, or production of a qualifying asset. I mean, when I say directly attributable, it means that you have solely borrowed money to fund the construction of that asset. You have solely borrowed my money to fund, not you borrowed the money for something else, to fund the construction of that money. So the interest to fund the construction of that asset, so the interest you then pay on that borrowing should be added to the cost of the asset. Okay, Sandra, you raised up your hand, right?
Yes, good evening, sir. So
Okay.
I want to understand something. So the finance cost, is it different from the borrowing cost?
No, it's the same.
So you treat them the same?
Yes.
Okay, that is just what I wanted to clarify.
Yeah. All right, good. Any other question before we move to... Okay, now, having understood the core principle, because that's everything borrowing cost is all about. Now, there are two issues. There are two set of borrowings we are going to look at. I'll look at the one that is a specific borrowing, where you borrowed money specifically to fund a specific asset. You borrowed money to fund a specific asset. That's specific borrowing. And also, we're going to look at a scenario whereby you have a general borrowing, which means that you have series of borrowings to either fund a singular asset or multiple assets. But maybe you borrowed money from bank A, you borrowed money from bank B, you borrowed money from bank C. So you have multiple borrowings to fund a singular asset or a multiple asset. Whatever the quantum of assets doesn't really matter. What matters is that there are multiple borrowings, there are general borrowings. So we're going to look at question on each of those scenarios when you have specific borrowing and when you have general borrowing, then that would basically be it on how you calculate borrowing costs and also how to capitalize it to the cost of the asset. So let's look at this question first on specific borrowings. So this question says that on 1st January 2016, Wellman borrowed 1.5 million to finance the production of two assets, both of which were expected to take a year to build. Work started during 2016. The loan facility was drawn down and incurred on 1st January 2016 and was utilized as follows, with the remaining funds invested temporarily. So these are the assets. The loan rate was 9%, and Wellman can invest surplus funds at 7% required. Ignoring compound interest, calculate the borrowing costs, which may be capitalized for each of the assets, and consequently the cost of each asset as at 31st December 2016. Okay, so at the beginning of the year, this guy borrowed 1.5 million and he's supposed to use it to fund two assets. And it's going to take 2 years to build. So they started work during the year. So the loan facility was drawn down and incurred on 1st of January 2006, meaning they took the money and started spending it from 1st of January 2016 and was utilized as follows. Okay. But there's something here that should catch your attention is that the remaining funds were invested temporarily, right? So what would be the impact of that on what we want to do? You'll see it very briefly. So at the beginning of the year, since there are two assets, on the plants, they incurred 250. On the building, they incurred another 500. They didn't incur any money until 1st July 2016, where they incurred additional 250 and an additional 500. So the interest they are paying to the bank is 9%. And remember that they invested surplus funds, so they are getting a return on that investment of 7%. So so in this case, what's the interest? Very straightforward. So I mean, the calculation can be as simple as calculating 9% of 1.5 million, right? 9% of 1.5 million. But if you do that, you'll be wrong. You'll be wrong. I mean, this guy can borrow money and not have spent so much for that year. So even if you now do 9.5 or 1.5 million, you find out that the interest might be higher in some cases, more than the money has actually spent, since you are adding it to the cost of the asset. So the way the calculation work is that the money you have spent is what you calculate interest on. Yeah, so that is that one you will capitalize. So we just want the capitalization, that interest that you are adding to the cost of the assets, to be on the basis of how he's spending the money, not to just apply the interest on the total money. That would be wrong. And that's majorly what you need to note here. That's the only technicality, that don't apply the rate on the total money borrowed, but you should apply the rate on the expenditure incurred. So let's break it down. So we have two assets here, plant and building. Now, the borrowing cost. So I'm calculating this at the end of the year. So for the plant first, remember I incurred 250 first. So I calculated 9% of 250. And they incurred that from 1st of January. So I am 9%, and this 9% is per annum, right? And since they started incurring this one from the beginning of the year, so that means they used it for the year. So 9% of 250 straight on, and that gives them the 2,500. You see this other 250, they started spending it on 1st of July 2016, which is almost halfway through the year. So when I'm calculating interest on that, I only capitalize just 6%. Sorry, just 6/12, half month. Since they started spending money half year. So that's why I prorated this other 250, giving me this amount, 11,250. Okay, please, you can ask a question. Go ahead, please. Okay, somebody raised his hand. You are muted if you're talking. Okay, let me know when you're ready. So you would capitalize that, and that's how you would calculate the interest as the expense are being incurred. That's on the plant. Now, on the building, again, the same way. This 500, we started spending it from the beginning of the year. So 9% for the whole year times 500 gives us 45,000. You see, this other one, they started spending it in July. So that's halfway through the year. So the expenditure incurred started in July. So when I'm calculating my interest, I won't give it interest. I won't capitalize interest for the whole year on that. is based on when you started spending that money. I mean, the question has made it easy for us. So that's why I'm prorating this other half as well. So that gives me this amount. Now, here comes the interesting part. Now, I mean, I'm removing investment income from this borrowing, which means that, you see, the surplus funds he had that he invested for a few months and he got 7% back, and he got 7% back as return on that investment. So that will help us reduce our borrowing cost. And yeah, from here, what's the surplus fund? Remember that he borrowed 1.5 million in January. And on this plant now, he only incurred 250 in January. And he incurred the other 250 until after 6 months. So he actually invested 250 for 6 months. Yes, now. So he spent 250 at the beginning of the year. He did not spend the other 250 until July. So that means he had this other 250 from January to July, like 1st of July. So 6 months. He had free funds which he invested and got 7%. The same thing for this other one also. He only spent 500 on this building at the beginning. So this extra 500 is spent later. He had it. He didn't spend it until July. So he invested that one as well. So you see, for the plant now, that extra 250 that he invested for 6 months from January to 1st of July, it gives 8,750. It's an investment income that will reduce our borrowing cost. The same thing for the extra 500,000 I did not spend until 1st of July as well. He invested it and got 7%. And also he only invested it for 6 months, January to 1st of July. So this amount will be deducted from the borrowings. See, when you cumulate this 22,500 plus 11,250 minus 8,750, we get 25,000 as our borrowing cost. The same thing applies to this. And when you add this 45,000 to this 25,000 minus this 17,500, we get 50,000 as our borrowing cost. Now, having determined our borrowing cost, that's not where we are going. What we are going is that this borrowing cost must be added to the cost of the asset. Now, as at the end of the year, the expenditure incurred on the plants was 500,000. I mean, 250 plus 250. Then the borrowing cost that has to be capitalized is 25,000. So you add 25,000. For the building, the expenditure incurred on the building is 1 million. The borrowing cost that will be capitalized is 50,000. So that gives us 1,050,000. And that's the end of this question. Do we have any questions?
Yes, I have a question.
Okay, please ask.
Yeah, sir, from the beginning of the year that for the money borrowed, I see we just times the 9% by the 250. Why didn't we do since from January to July is like 6 months, 6 divided by 12 that times like we did in the second one. We just did for the first year directly 9% of 250.
Okay, yes. Logical question. So, I mean, there's nothing that is saying here that this 250 was spent for 6 months. And what is important is we don't know how long it took them to spend this 250. What is important is this 250, out of the money we borrowed, we started spending it from the beginning of the year. So we assume it was spent all over, right? And they did not start spending another one. So, I mean, that means the key indicator here, the one that we know that we can see obviously here, is when was the expenditure incurred? When was the expenditure incurred, right? So it's because you are seeing this July. That's why you are thinking that maybe they finished spending this money in July. That's an assumption, and we cannot work with that. What if they did not, this July is not there at all, and they just told you that, okay, 1st of January, they spent 250. They just said that. So you would assume that, okay, 1 year, right? That's exactly what you should assume. So the key thing is, when was the expenditure incurred? So this one that was incurred at the beginning of the year, from the beginning, so you give it 12 months. So anyone that was incurred, that it was drawdown, the expenditure was commenced during the year, that you prorate. So that's the logic we have to follow. I hope I answered your question.
Yes, sir. Yes, sir. Thank you, sir.
Okay. Any other question? Is your hand, but you're not saying
Okay,
anything.
good evening, sir.
Good evening.
My question is on the investment income. Why are we
Okay.
charging it to just be 6/12, half of the year, since the borrowing started from January and it's taking us through to
Okay.
December 31st? So why are we charging just half of the year on the investment income?
Okay. Good question. Okay. So this investment income is return from surplus funds, right? And if you look at this plant, for example, we incurred only 250 from the beginning of the year. We incurred only 250. So that means we had an extra 250, which we did not incur until July. So the question, they told us that we invested it, right? So that means we invested this extra 250 that we did not spend until July. We invested it from January to that 1st of July. So we invested it for 6 months. And the same explanation goes for this building as well. We spent 500 at the beginning, and we did not spend this other 500 until July. So we invested it from January to 1st of July, which is 6 months. So that is why we prorated that investment income for 6 months, because we only invested them for 6 months. Did I answer your question?
Not really, sir. Like, let me explain. Are you saying, for plants, we borrowed 500, and for building 1,000, and you are saying from January to June, it was 250 that was used? Is that what you are saying, sir?
Yes.
Okay, and the remaining 250, I'm talking on plants now, and the remaining 250 was used from 1st of July to December.
Yes.
So now that we now want to less our investment income, are we just picking any half of any part of the money? Because I think we should just use the whole 12 months. But while we are using 6 months, are you saying because we divided the money into two? Like, if you get me, sir?
I hear you, but I don't know.
Because I'm asking this because let's say we are having different figures used for the 2 months, different amounts. So what amount are we to pick? Because this one is just same amounts now, and we can just assume we are picking either January or July. But in a case whereby the amount borrowed for the plants, and yet it's different period that we execute the project with different amounts, are we just going to pick a random amount, or how do we treat that, sir?
Let me
Or the
explain it.
explanation was not clear enough.
Let me explain it again, but it's still the same thing I will still say.
Hello, Mr.
Okay,
Wasim.
Yes, Latif.
Can you allow me that I come into that discussion?
Yes, please.
Okay. I think what we need to understand is that the whole of that 1.5 million have been separated and be shared between the two projects. 500 for plant, 1 million for building.
Building.
So that of 1 million for building, from 1st of January to 31st of June, right? Only 500 naira have been spent for building. It means that from 1st of January to 31st of June, 500,000 naira remain in that purse untouched, that is the one that was used for investment to get that 7% return. That of the plants, only 250 have been used from 1st of January to 31st of June. The remaining 250 was untouched until 1st of July. Therefore, that from 1st of January to 31st of June, that 250 was reinvested to get a return of 7%. So that is the logic. So the money have been shared from the beginning. It has been shared between the two projects from the beginning.
Okay.
So that
Are you saying surplus fund is, let's say, okay, the way the plant is actually 500, and let's say if, from January to June we use 300, remaining 200, you get that, right?
okay.
So are you saying if I want to less my investment income, am I going to less on the 200 that is remaining, or it is
If
the
if
used
if,
money?
if the question says it was reinvested, this one
Wait,
says
I'm using this question now. Get my point. Like, I'm still using this question. Let's assume is that January 2016 we used 300 and we are having 200, and they say where man can invest surplus fund. Okay, the surplus fund is the remaining amount that is remaining, right? The 200.
yes, ma. Yes, ma.
Okay, so if I'm charging my less, if I'm removing my investment income, I'm going to charge it on the 200 that is remaining.
Based on the number of months that the 200 was used, and based on the percentage, it was the returns, the percentage of the
Yes, I
return.
get the percent. I'm just changing the figure word to word with
Exactly.
this thing. I know
Exactly.
I get the percentage part. So it's the
Exactly.
200 that is remaining. I'm going to charge my investment on.
Based on the month.
Okay, thank
Okay,
you.
sir. Okay, sir. That's my conclusion, sir.
Yeah, thank you very much, yeah, Latif. So,
Thank you, sir.
yeah. So, like he has explained again, on the plant, we had 500,000. We only spent 250. So whatever is remaining, I mean, it's just a coincidence that we are having equal amounts. Whatever is remaining is assumed, not even assumed. The question have to tell us. So if the question does not mention that the fund was invested, so the issue of investing borrowing funds will not even come up. It's because the question actually told us that they invested it. That's why the money they did not spend, we are assuming that we'll have earned 7% on them. So, and that applies to the two assets. Okay. And we can see it in other questions. But I mean, the important thing is that they need to tell us that the money was actually invested. Okay. So it's good we had that long discussion on this one. So the others, you understand it very fast because it's the same. That's all about this standard. It's really not more than that. Okay. Yeah, Sandra.
Okay, sir. So if the question did not tell us that the remaining funds, that place, that part, so that means we are not lessening investment income.
That's correct.
Oh, okay.
That's correct. Okay. So the second part, which is the final part of this standard, is that unlike this one now, where we borrowed money, just a single money to fund two assets. So this one we call it specific borrowings. So you borrowed a single money, 1.5 million, and it's very clear that you're paying 9% per annum. Now, what if the company actually borrowed multiple money? It borrowed money from bank A, from bank B, it's a practical thing that can happen. If the money that you want to borrow is so much that a single bank will not give you, and you need to borrow from several banks, and you are using it to fund either a single asset or plenty assets, like that. Just like when Dangote was constructing his refinery, he has to borrow money from many banks. So how do you treat that? How do you calculate the interest? What is the major challenge there? Is there anybody that can really look at it and see that, okay, this is the challenge you would have How is that different from single borrowing in terms of calculation of interest? Can you see the challenge? Can anybody see what the challenge you will face when he has borrowed multiple money?
Yeah.
Okay, Latif, yeah, tell us.
The interest rate will be different.
What do you mean by that?
The cost of capital from different bank will not be the same. Bank A may charge 8%, Bank B may say 20%, Bank C may say 10%. That is one of the challenges.
Fantastic.
And I
Okay.
think the repayment pattern of each bank might be different, and also the period of the loan certainly might be different from bank A to bank B.
Good idea. Very good.
They,
Okay. Okay,
the
Esther, go
cost
ahead.
of living will increase drastically, will be on the high side compared to when the source of the borrowing is just in one phase, it's just specific. But when it turns to multiple, the cost of borrowing will be added to form part of the asset. So the cost of the asset will be huge.
Wow. Okay, very intelligent contributions. So, and I think every one of you, you're perfectly correct. So one way or the other, like what Latif mentioned, that the cost, we will not have different rates. Why Bank A is saying pay 10%. The other Bank B might be saying pay 15%. The Bank C might be saying pay 13%. And also it depends on how well you're able to negotiate. So, and the practical challenge there is how do you then calculate the interest? Unlike this one, we're able to calculate, we know that it's 9%. And the major challenge is that, remember, it's not like the interest is not calculated on the money you borrowed. It's not so. If it was calculated on the money you borrowed, it will not be a challenge because we will just calculate the interest separately. But the major thing in borrowing costs is that we calculate the interest on the expenditure incurred. So which was why we had to prorate even this one, because it is as you are spending the money, then capitalization will start. So in such situation now, which rates are we going to use? Which rate are we going to use? That is the major challenge. Which of the rates are we going to use to calculate our interest on the amount that you are incurring? Yes, the period also is also a very practical issue, but I mean, borrowing cost has solved that to a large extent because capitalization will stop when construction is completed, right? So the period of the loan will not be a major issue, right? And also the interest amount you are going to pay because of that multiplicity of rates now. Yes, so I agree with the other person that said, okay, the interest is going to now be higher, right? So, I mean, what should we do? What we're going to do is that we're going to use a weighted average of all those rates. So if one is 9%, if one is 10%, if one is 13%, we are going to weight those, we're going to do like a weighted average. So that weighted average, IAS 23 calls it capitalization rate. That is what IAS 23 calls it, capitalization rate. So in the exam, you would be required to calculate that capitalization rate. Very straightforward, no technicality. As soon as you're able to calculate that capitalization rate, then that is all. You just need to apply that rate on the expenditure incurred. You see that I keep repeating that statement. The rate is calculated on the expenditure incurred. So always remember that. So let's look at this past question. So for that, so let's pay attention and ask questions on areas not clear. So this company, Power Limited, had the following loans in place at the beginning and at the end. So he had the following loans. Number one is 10% bank loan that is repayable in 2018, right? That's when he will pay back. So he already borrowed it, 120, and it's still in his books. He hasn't paid back. It's still there, 120. Another loan he had is 9.5% bank loan, which is going to repay back in 2019. So 80. It's 80 million, and he hasn't paid back. It's still there at the end of the year, 80 million. Then another loan, 8.9% debenture, which is going to pay back in 2017. So this one, he borrowed it during the year. So it's still there on 50 million now. So that's the money. These are the money he borrowed in 2016. 3 loans. So these multiple borrowings. Now, they now want to analyze it for us. They said the 8.9%, that is this one, was issued to fund the construction of a qualifying asset. You see, what this question is now doing is now separating, is taking out this one from the pool and saying that this one, no, we didn't take it for as part of the order. So this one, we specifically took it to fund a qualifying asset, a piece of mining equipment. So that means this 8.9% becomes specific because it was used to fund a specific, to fund it. They told you that it was used to fund this particular asset. And they said the expenditure was 40 million. And this is what is important that you should look out for in the question. Because the expenditure incurred, because that's what you're going to apply the rate on. And construction began on 1st of July. This is another very important one. When did they start construction? That is when and of course, that's when the expenditure was, the commencement of the expenditure would start. So that means this 8.9%, we can easily apply it on the expenditure incurred. They will prorate by 6 months because we started spending on 1st of July. Prorate by 6 months. If you had started spending on 1st of January, that means we won't prorate. Because when you start spending on construction, construction is still long. It's from when you start, that money is assumed to be useful all through until construction. But for this one, it's from July to the end of the year. Now, that being said, they now said at the beginning of the year, they said this company began construction of a qualifying asset, a piece of machinery for hydroelectric plants using existing borrowings. This is where we are going. Using existing borrowings. So that means they used this one, this 10% and 9.5% to fund another asset. So expenditure drawn down for the construction was 30 million on 1st of January. You will see now, this 30 million, this expenditure incurred was on 1st of January. You see this one will not prorate because the expenditure incurred was on 1st of January at the beginning of the year. We will not prorate. While 20 million was incurred from or on 1st of October 2016, this one will prorate by 3 months because they started spending this one on 1st of October. So we'll only capitalize for 3 months. That's the logic here that you need to get right. Then you will get all the marks right. So now, you see, what you should be thinking about is this. On this second one now, or let me see if somebody will ask. Let me see if somebody will ask. Let me just solve it. If nobody asks, then I will then bring it up. So let's solve this one. Now, you see, for this question now, I've already solved one of it, which is this first paragraph. This 8.9% that was spent on this mining equipment. So it's simply 8.9% multiplied by 40 million, multiplied by 6/12. And that's what we did here for this one. So this one is very straightforward. So the borrowing cost is 1.78 million. Because that one is 8.9% was issued to fund a specific asset. So that's a specific borrowing. Okay. Somebody wants to ask a question? Please go ahead.
Thank you, sir. So let me
Yes.
get you correctly, sir, regarding the specific assets. I thought
Okay.
earlier you said you were referring to, it was specific asset that we solved earlier. And that's
Yes.
because it's a single borrowing. So we move
Yes.
to generic borrowing, where we have multiple borrowings from different institutions. And now you
Yes.
are referring to the debenture, the 8.9, to be a specific asset, a specific borrowing. So that part
Yes.
is confusing.
Okay.
I thought,
Okay.
I think the all this borrowing stuff, they are all together. And because it's more than one, that's why we are calling it generic borrowing. But now that you are single-handedly calling this 8.9 debenture to be a specific borrowing is it's
It's
confusing.
confusing.
So why is this one specific borrowing? Or is it because they actually specify that it's used for qualifying assets, the piece of the mining? Because I could see it from 1st of July of January 2016. It was specified
That is
that
why you have just answered your question. That is why.
but in this other stuff too, 1st of
In,
January, it was
in
also
the
specified
second
that
paragraph,
it is a yes, that it is a qualifying asset too. Is that one a
eh,
specific borrowing too?
no. So you know that the thing about this other one was that they now used existing borrowings
Okay,
for this
because
second
the
paragraph.
8.9 is a new borrowing.
It's not really that is a new borrowing, whether it's a new or old. The fact is that the question told us that this 8.9 was used to fund this particular asset. So that's what we mean by specific. When you borrow money to fund a
For that
particular
particular
asset.
project, and it's not existing
Yes.
borrowing.
So even if it is existing borrowing, itself, it doesn't matter. But what is that? That money was for a particular was for that project.
Sorry.
Hmm? Are we together?
Yeah.
Okay, you see, and for this one now, what is special about this second one is now it is now more than one borrowing. They are using existing borrowings. That is the other borrowings that we have to now fund another asset. So that's general borrowing, using more than one borrowings to fund a particular asset becomes more than one borrowings. And that is generic or general borrowings. So
Excuse me, Mr. Asif.
yes, Sunday.
Yes. So, where this borrowing are done at a different period, how do we treat this? Because what I'm seeing now, I'm seeing that this borrowing we are done at once from the statement, from what you just explained in the solution. Sorry, from the second paragraph.
Yes, yes, and expect something like this in the exam. So you know that you are only concerned about a particular year. How much interest are you capitalizing for that year? Okay, so for example, now this money were there in our books at the beginning and at the end of 2016, right? So we are concerned about 2016. Okay, so anyone that they borrowed after 2016 is really not our business. But that means this money you are seeing here, they have borrowed them before 2016. because I mean, it was in their books at the beginning, except for this third one, this 8.9% that they borrowed during the year, right? So the period when they borrowed the money is not really an issue. The issue is that when was the expenditure incurred, and there is a borrowing that we are using to fund it. It's just to apply the rate on the expenditure incurred, focusing on when we started spending, or focusing on when we started spending money on that project, because that's when capitalization is going to start of that interest. So did that attend to your question?
Yes, that's fine. That's fine.
Okay, any other one? Any other person? Okay, so this first part is the same thing as we have done before, because the 8.9% was used to fund a specific asset. So calculating the interest is quite straightforward. No need for any capitalization rate. But you see these other assets, these hydroelectric plants, because you are using existing borrowings. So the challenge is, okay, which rate are we using? Is it the 10% or the 9.5%? Right? So that's where the issue of capitalization rates will surface. So how do you calculate the capitalization rate? So that capitalization rate is just the first loan, let's say 10%, which is the first loan. You then look at the money that was borrowed. Okay, so we had two loans here, 120 for the first one, 80 for the second one. So we want to get weighted average of that borrowing. So since the total is 200, so this 10%, it relates to this 120. So 120 over 200 multiplied by 10% plus the second 9.5% that relates to the 80 million over the total borrowing. Okay, that's what we call weighted average. So getting the weights based on the money that was actually borrowed. So the 10% that relates to this 120 over the total money plus 9.5% that relates to this 80 over the total money. So, and that, even if it is 10 borrowings, this is the logic you will continue to use, right? So it's just the rates multiplied by what's the money you borrowed with that rate over the total plus the rates multiplied by the money you borrowed with for that rate over the total, like that. So when you punch this on your calculator, and you do it separately, when you do 120 over 200 multiplied by 10%, you write it down. You do 80 over 200 multiplied by 0.095, that's or 9.5%, you write it down. If you add the two together, it gives you 9.8%. Okay, so somebody's asking, is it possible they give us in a question and they didn't the expenditure incurred? Yeah, let me know if it's not possible. If they don't give you the expenditure incurred, then that means they want to make your life easy. Just apply the rate on the amount you borrowed. If they don't give us the expenditure incurred in the question, just apply the rate on the amount borrowed. I mean, that makes everything easier for you. Okay, so we have 9.8% as our capitalization rate. So our borrowing cost now, since we now have a rate that we can use, then what was the expenditure incurred? We incurred 30 million at the beginning of the year. Okay, so we apply 8%. I said 8%. We apply 9% on that 30 million. We don't need to prorate this one because the expenditure was incurred at the beginning of the year, so full year. Then we have also applied 9.8%. Look at this 20 million. It was incurred on 1st of October. So we apply that also on 20 million. But now we're going to prorate by 3 months. October, November, December, 3 months. Like that. So if you do this 9.8 times 30, whatever you get, write it down. 9.8 times 20, whatever you get, write it down, then prorate it times 3 over 12. If you add it together, it should give you 3.43 million. Okay, and that's the entire idea around capitalization rates. Any questions? Any questions? Nobody's going to ask what I was expecting you to ask. I thought the lady, your name is not showing on your Zoom, which is why we say you have to register before you log in. So I'm surprised your name is not showing. So what's your name?
It's Christiana
Okay, Christiana. Okay.
Ediagbo.
Oh, okay, good. Okay, so I was hoping somebody was going to ask me that this 8.9%, why are we assuming that they did not use it as part of, because they said using existing borrowings, and they borrowed 150, right? And they told us that yes, 8.9% was used to fund the qualifying, but they spent only 40. So why are we assuming that the remaining 110 was not part of these existing borrowings? Why are we assuming? I thought somebody was going to ask and we are going to discuss that. Another person will then explain, but nobody figured that. Well, I mean, that means you understand why we did not assume that. But it should have been a valid question. But in the exam, you can
No,
see
we do not
something like,
understand.
No, we do not understand, sir.
okay, good. So in the exam, right, you don't assume that, okay, the money that is remaining was also used to fund these new assets. Don't assume, except if the question was so specific that that is very clear. Okay. Otherwise, assume that this 8.9% was for this loan and this loan alone. Alone. Because there is nothing that says here that they have completed this construction. They just only told us that they started on 1st of July. So we cannot assume that, okay, so the remaining money, they diverted it. They have not completed construction, right? They did not tell us that. That's one. Even at that, you have to, if the question has separated it, leave it separated for them. That, okay, this 8.9% was for this one, then fine. Keep it simple. FI is so straightforward that you keep it simple like that. So this 8.9% was for this one. So let it be for that one. Then the others, the existing borrowings was for this other one. Then use the existing borrowings for those other ones. So don't start assuming that, okay, the remaining money they did not spend on this one will have gone to that one. Right? Don't assume. Okay. So that's the only thing I was expecting you would ask, but please don't try to complicate it like that in the exam. It will not be favorable for any one of us. Okay. So is it for this. Now,
Yes, sir.
I'm sorry, yeah, go ahead.
Yeah, sir. The only what I'm seeing in that the one for 8.9, I saw that it was borrowed on the 31st, 20 December 2026, and the expenditure took place on say July 1st of July 2026. So how comes we are now doing six? We are now prorating it by
Okay, that's a valid,
six because the
yes, that's a very valid question. So the notion that this amount was here at the end of the year, it does not mean that it was borrowed at the end of the year. Just like the way this one was here at the beginning does not mean it was borrowed at the beginning. It has been there. Okay. So it
Okay.
was actually borrowed during the year, but the question did not tell us when it was borrowed because really it's not important as far as borrowing cost is concerned. What is important is when was the expenditure incurred? When the money was borrowed, even though practically you would need it, but I mean, rationally, you will not start incurring expense if the money was not there. That means the money was there. Okay. And for our own calculations, what we need is when did we start spending money? Because that is when capitalization of this interest will start. That is when that's the relevant period for which we are going to calculate interest. So they didn't borrow it. Are you still with me?
Okay, you are back because the network somehow break, but you
Oh, okay.
are.
I'm back
I
now.
get what you just explained now, sir.
All right, good. Okay. Now,
Yes,
another,
sir. So
yeah,
for
please.
the 8.9 debenture, that
Yes,
cost of borrowing that was calculated, this 1.78 will be
yes,
added to form cost of the asset. Are we adding it?
yes, to be added.
Then for this other two, the amount we got will be added to form part of cost of the assets, right?
Yes, yes, to be added. Yes, it will be added. So I just focused on what the question told me to do, just calculate the borrowing cost. So I mean, the ideology is that this amount will be added to the cost of the assets. This one will be added to the cost of the assets for that year, like that.
Excuse
Okay.
me, Mr. Ashi.
Yes, Sunday.
Sorry, I have to take you back a little. This the 8.9, if
Yes.
I get you well, because from what I'm saying, is it why it was not added to the other ones while we are solving it? Is it because it was meant for a specific project? Is that why?
Yes. Yes,
Okay.
that's right. That's right.
Okay. Thank you.
Yes. Any other questions? Okay. So we are done with calculations. These other ones, you need to note them for 3 marks question, for 4 marks question in the exam. They're very important, which is when do you start capitalization? When do you start capitalizing interest? So, I mean, by now you should have understood that it is not when you borrowed money that matters. That's not what is important. What is majorly important is when did you start spending money? So before you commence capitalization, 3 events must have happened. 3 events or transaction must be taking place. Number one, expenditure on the asset is being incurred. Number two, you have borrowed money and you're paying interest. Borrowing costs are being incurred. Number three, activities are in progress necessary to prepare the assets for its intended use or sale. You see, these other ones is just saying that aside spending money, aside starting construction, activities are in progress to prepare the assets. Could be that maybe you want to construct a building and you need to get building permits, or you want to drill an oil rig and you need to get license, or you are a telecom company and you want to pass your fiber optic cable underground and you need to get like a permit from what do they call this agency? Nimasa, I don't know, Nasimra, like that. Nasimra, that's in Lagos State. So all those are activities are in progress. Those are the three events that must be taking place before you can capitalize borrowing costs, before you can start. Expenditure is being incurred, borrowing costs is being incurred, activities are in progress to prepare the assets for its intended use or sale. Latif.
Yes, sir. The three must or one of.
Is the three.
Okay.
Is the three. So in the exam, you need to try and know these three for 3 marks question in the exam. Okay, any other questions? Another one is suspension of capitalization. When I say suspension, I mean, when can you pause capitalization? That's okay, you not capitalize. So you would suspend a capitalization if active development is interrupted for an extended period. I mean, this is as simple as you stop constructing for no reason. You just stopped. So of course, you still be paying interest to the bank. You cannot capitalize that interest for that period where construction stopped. You cannot stop. So you cannot just stop construction. It means that you will not add the interest you are paying to the cost of the asset anymore because you're not spending any money. So you'll be expensing whatever interest that you're paying. You cannot capitalize it. You expense whatever it is. However, if the suspension, okay, is as a result of maybe temporary delay that you have to stop work, or probably maybe you're constructing a structure and you are at the decking level and you have to wait for like 30 days or 28 days, something like that. So those ones are just temporary delays. So whatever interest, you can still be capitalizing the interest. Okay. So the key thing here is that you can only suspend capitalization of borrowing costs if active development is interrupted for an extended period of time. Okay, so you don't have to suspend if it's just a temporary delay. That is part of the normal process of construction. So those temporary delay will not affect capitalization. Yes, Latif, go ahead, please.
Well, sir, what if that temporary delay for that suspended, rather, the project is being interrupted for any extended period? If that cause of that suspension is beyond your own control, maybe like during COVID-19 or natural disaster or something that is not you that caused the suspension.
Okay, so you have to stop capitalization. If I want to apply this standard strictly, so for you not to stop, for you to still be capitalizing, I mean, the temporary delay must be part of the process. That is, but if it's issues like of course, these things happened in 2020. So there were some countries actually passed circulars, addendum, so that they can capitalize those interests they are paying to the bank. In fact, some banks even did stoppage of interest. So there were a lot of things that happened. But if it's issues beyond your control, that is not part of and that is not part of the technical process, you have to stop. You have to. That's what this standard is saying. Whether it's beyond your control or not. What is important is a temporary delay and is not, there's still activities, administrative work going on. Not that you just stopped. Even during COVID, you stop capitalization. Latif, did I answer your question?
Yes, sir. Thank you.
Okay. Any other question?
So, what are the examples that can stop the active development? That can interrupt the active development?
Maybe like in Lagos State now, Alaka, they came to close your site.
Why my sites?
Very funny.
Okay, sir.
Something like that, or whatever events that has happened, or probably maybe you diverted the funds and you don't have money again. Also, I mean, a lot
Okay.
of like that.
Okay.
Okay, so the final part of this standard is cessation of capitalization. Cessation of capitalization. So, I mean, when do you stop capitalizing? Like even when you're still paying interest, that you cannot capitalize anymore. And it's as simple as when all the activities necessary to prepare the asset for its intended use are complete. Meaning, as soon as you have completed construction, then capitalization would cease. Meaning, physical construction is complete, even though there are still minor modifications here and there, but physical, no more construction. The building, the equipment is ready for use. So, when physical construction of the asset is completed, you stop capitalization. So that also goes for if you have buildings, like let's say you have multiple buildings or a plaza, and you are completing them in stages or in parts. So as you are completing it, capitalization will be stopping in parts. I mean, that is why for this standard, you would capitalize based on the expenditure that you're incurring, based on the expenditure you're incurring. So as soon as construction is complete, you stop capitalization. So that is it for this standard. Of course, every standard has a disclosure requirement. So for this one, the amount of borrowing cost capitalized during the period, you have to disclose it. It's very, very important. You need to disclose it separately, how you have computed it. And of course, if you are using a capitalization rate where there are multiple borrowings, so you need to let us know how you determine that capitalization rate. You need to tell us.